Hey everyone, welcome back to Smart Credit with Sangeeta. I'm your host Sangeeta, and today's we are diving deep into something that can make or break your business loan application, that is the CMA report. Did you know that 70% of MSME loan rejection happen because of poorly prepared CMA reports? But here's the good news. By the end of this video, you will know exactly how to create a winning CMA report that banks love to approve. So grab your notebook, hit that subscribe button, and let's decode the mastery of credit monitoring arrangement together. A well prepared CMA report can be the difference between your loan approval and the rejection. It's not just about the numbers, it's about telling your business story convincingly. Do you know that above 5 CR, the CMA report is compulsory as per RBI, and the minimum DSCR required for any bank, or maybe you can say that acceptable by many of the banks, is 1.25, and this all you find in the CMA report. But you will learn today what is exactly the CMA report and why bank demand it, the four critical components every CMA must have, step by step preparation process with real examples, common mistakes that lead to loan rejection, pro tips from credit analysts that actually work, and free templates and resources you can use right away. So let's start with the basic. What is CMA report? CMA report is known as Credit Monitoring Arrangement Report. This report shows the projected performance, the past performance. The projected and the past means the future and the past performance of your company or your business, basically in numbers form, or you can say that in financial terms. It is compiled with all the required financial ratios and metrics to help financial analyst and your banker to ascertain the financial health of business. Think of answering the question, can this business repay the loan? This is the question all the bankers ask before giving you loan. Can you repay it? And the CMA report tells the story. Here are four pillars of the CMA. First is historical financial analysis. This tells the revenue trends over 2 to 3 years, your profitability ratio, debt service coverage, and year on year growth patterns. The pillar number 2 is current financial position. Current assets versus your liabilities, current liabilities, working capital requirements, existing debt obligation, and your cash flow position. Pillar number 3 is projected financials, means your future. What is your realistic growth forecast? Detailed revenue sources, cost component breakdown, and market aligned projections. Pillar number 4 is fund flow and utilization. How you will use the loan, that is the detailed loan users plan. Sources of repayment, how will you repay the loan you are taking. Fund utilization timeline, in how much time will you use the fund you are taking. And impact on operation, the loan you are getting, how will it sorry, how will it impact your operations. Pro tip from my side is, so that 70 to 80% of the loan will be used for revenue generating activities. Banks love to see productive use of funds. Excuse me. Let's go to step by step CMA preparation. The first step is gather your documents. In this will be collect last 3 financial year statements, bank statement, tax return, and market analysis report. Second step is prepare historical analysis. Analyze your past performance trend, growth rates, and profitability ratios. Next is step is calculate working capital. Assess the needs based on your inventory days, debtor days, and creditor days. Then evaluate your repayment capacity. Calculate your DSCR, that is net profit plus depreciation plus interest divided by your interest and principal repayment. Conduct risk analysis. Address market competition, operational and financial risk honestly. Let's take an example of real world that is Electrocom. Here you can see that the year-on-year growth is on an average of 18.11%, and this is normally acceptable. You can take any balance sheet and you can analyze year-on-year growth. Notice the consistent growth pattern that builds bank confidence. So here is 18.11% and that is consistent in past as well as in future. Okay, let's go to common mistakes and expert tips. What are the common mistakes you usually make? First is some people just to borrow the loan, they give unrealistic projection that is not acceptable at all. They show 100% revenue growth without even justification, no work orders, nothing, just because they require loan. They give the unrealistic projections. How to fix it? Project conservative. 15 to 25% growth is acceptable with detailed explanation of how you will achieve it. You need to explain how you will achieve it. Maybe in some cases I have seen there is more than 100% revenue growth. They get unexpected order from the government that is confirmed and they require funds. So that is acceptable in exceptional cases, but not in every cases. Second is ignoring seasonality. They show that identical monthly sales throughout the year. Suppose we can say ice cream business that works mainly that is on its high peak in summer, but if it shows that it is on peak throughout the year, that is not acceptable, and you can easily point out that, and your banker will immediately reject the loan seeing this pattern. How to fix it? Factor in seasonal variation appropriate to your industry, right? A practical example for the credit officer or finance professional is you can also check last 2 year the GST return. And how to check seasonality, I'm telling about that. You can check their month on month growth or month and month sales, and you can compare whether this is a seasonal business or the sales is throughout the common sales is throughout the year. Next mistake is underestimating working capital. Calculating exact working capital with no buffer. This is a very big mistake. You need to add 10 to 15% buffer for unexpected requirements. You never know, this is business. Okay. Next is poor presentation. I've seen some, not many of the customers, they don't digitize their accounts. I have 100 times advised, just go digital. This will save your time and create a proper documentation. They just hand over handwritten or poorly formatted documents. Since they have no proper record, they always maintain manual record and they give such a poor formatted documents. How to fix it? Use professional Excel sheet with clear formatting and visual aids, and this is possible in many of the apps. You can say QuickBook, Joho. You can use any app; they are all free. What are the red flags that bank hate? Inconsistent data across statements. Really, unexplained revenue spike. I already told you that you are giving 100% revenue increase for loan, not acceptable at all. High director remuneration relative to business size. This is a very red alert in private limited company. Unrealistic debt equity ratio. You always have to look at your DR ratio. Okay. Now let's go to resources and templates as promised. Free downloads available are CMA Excel template, ready to use format. You can download it from my website smartcreditswithsangeeta.com. Industry ratio benchmark, compare your business. You can calculate it from there also. Checklist for CMA preparation, ensure completeness. You can also download the business loan requirement checklist from my website, and sample CMA reports, learn from approved cases. These all are available in my website. You can go there, go right now and download it. Okay, and it will be really very helpful for you. Now, professional help option, you can also suppose one is not qualified, they don't know how to prepare it, and instead of wasting their time just to juggle between paper, they can always go for professional help options. They are certified chartered accountants. Online CMA preparation services, there are many. You can go online or there are many freelance worker. Banking workshop and webinars, many banks provide their customers directly, and their banking relationship manager can tell them. Money saving tip is that many banks CMA provide CMA formats for free. Contact your relationship manager, they are usually happy to help. I told you, you can always ask your, before going to anyone, you can ask your banking relationship manager whether they can help you regarding CMA preparation. Next is industry specific guidance. So let's start with manufacturing. Focus on capacity utilization, detailed raw material procurement strategy, include machinery depreciation schedules, and show production efficiency metrics. The one that many I've seen many report that financials, they never the manufacturing units never include machinery depreciation schedules. They simply just they estimate and they put the depreciation value. But what we banker require is the schedule, how you have calculated the depreciation. So now next, industry is trading. Sorry, emphasize inventory turnover ratios. Always demonstrate supplier diversification. This is very important. Never concentrate, since you are trader, uh, never concentrate on a single work order or a single supplier. Highlight customer concentration, very important, and detail market penetration strategies. Next industry is our service industry, very safe, since no machinery, no very less capital, right? Highlight human resources cost, important. Showcase client retention rates. If you are into service industry, you know that the client retention is very much important for you, and you have to show that to your banker. Include service delivery timelines, in how much time you can deliver your services. You need to include that and you need to show to your banker. Emphasize recurring revenue models. So next is retail industry. Focus on location advantages, because retail industry work on that. Show footfall and conversion rates, and include your expansion plans, very important for your business loan. And detail inventory management approach. Okay, always tailor your CMA to reflect your industry's unique characteristics and success metrics. Your CMA action plan. So what are the key takeaways? A comprehensive CMA is your business financial report card, and the key is to loan approval. I told you that this is your progress card, your past performance tell your progress card, and your future, how you will improve, how you will utilize the loan. And this is the key to your loan approval. Focus on 4 pillars. I told you: historical performance, current position, realistic projections, and fund flow. And always avoid common pitfalls like unrealistic projection and poor presentation. Tailor your CMA to your specific industry's requirement. I will prefer that you go for a professional help, so that you can get, because they know what to do, right? Next step is download the free templates from my website, gather your financial documents, and always check in 3 months. In my every video I focus on this. Always check your always check your documents every 3 months. Follow a step-by-step preparation guide. Review and refine before submission. Remember, a well-prepared CMA report can be the difference between the loan approval and rejection. It's not just about numbers, it's about telling your business story convincingly. So now we are at the end of the video. Drop your CMA question in the comment below. Share this video with fellow entrepreneurs, finance professional, banker, or anyone who needs this. Hit the bell icon for notification on new banking content. If this video helped you understand CMA reports much better, give it a thumbs up. Your support helps us create more valuable content for the MSME community. Until next time, keep growing your business smartly. This is Sangeeta signing off from Smart Trade with Sangeeta. See you in the next video.